Hi everyone, welcome back to the USCPA classes for financial accounting and reporting. This is part 2 of inventory accounting. In this particular video, we'll be covering in detail about gross profit method and subsequent measurement method of inventory valuation. So let's dive into to understand more in detail about accounting for inventory.
Hi everyone, welcome back to the FAR class for inventory. So now we'll be covering gross profit methods for inventory valuation, and then after we'll be discussing on subsequent measurement at the period end, which is lower of cost in market or lower of cost or NRV. So we'll be discussing that, and I think that is it, not much. So 1, 2, 3 pages, so maybe 4 pages. Yeah, so we don't have too much, maybe like next 40 to 50 minutes we'll be finishing now. So gross profit method. Gross profit method, I'm sure you might have studied this method in your college days. It's very much similar what you might have studied in India also, because in India and US GAAP there is no much difference in the gross profit method. LIFO and dollar value was different, which we have studied, and which we are not exposed to, but this is very much similar what you might have studied in your graduation or in your masters. So in the gross profit method, this has been used to estimate the inventory cost when physical inventory is impossible or impracticable. So this is the method which is allowable and acceptable, but in special circumstances. Every time you cannot use this, right? Like for example, if you have any, sorry, if you have any plant or inventory lying in any war zone, or maybe any zone where practically not possible for you to go and do the inventory count. So in that case of scenario, you can use gross profit method to do the valuation of the inventory lying in such place. It can also be used to test the reasonableness of the physical inventory. So this can be used for the testing of reasonableness, but not the actual computation when everything is available. But everything is not available, then you can use this as an alternative method, right? Gross profit method should never be your primary method of doing inventory valuation, but it can be considered as a alternative method when situation are not in favor. Make sense?
Yes.
Gross profit method is based on prior period experience of relationship between sales and gross profit. So that is gross profit divided by sale. How do we calculate gross profit? How do we calculate gross profit?
So net sales minus cost of goods sold.
Gross profit is equal to net sales
Minus
minus
COGS.
COGS. Right? So GP method is used to calculate the inventory value at interim period. You can consider for any insurance claim, like in case of fire, destruction of property, escalation, any such reason where it is hard for you to identify each and every item, right? And then for estimation of inventory, or you can say during, you can say quarter close or maybe half year ending. In such situation you can use, but for year end inventory you should not use it unless and until there is any special circumstances. Make sense?
Yes.
So there are 4 steps to calculate the GP method inventory. First one is determine the cost of goods available for sale, that is your opening inventory, plus purchases, which we have discussed in earlier method also.
Yes, sir.
Second is calculation of prior period GP ratio. GP ratio is
Gross profit upon
gross
sale.
profit divided by net sales, right? So rate, percentage, ratio, whatever the way you can calculate that, and apply that to the current period sales to determine the current period gross profit, right? Then sales minus gross profit is equal to your cost of goods sold. How do you calculate cost of goods sold? Sales minus gross profit, right?
Yes.
And how do you calculate the closing inventory? Your cost of goods available for sale minus COGS is your
Closing inventory.
closing inventory,
Closing
right?
inventory.
So if you remember the formula here, I can put it, note, closing inventory is equal to opening
plus purchases.
plus
Hmm.
purchases minus
COGS.
yes, right? So if you reverse this formula, if you have to calculate COGS, then you will shift the
Net sales minus
opening
gross
inventory and
profit.
purchases,
Plus
right?
purchases minus closing.
मैंने उधर करके बोला बस.
Yeah, you're right. Right?
Yes.
Yes, sir.
So now let's do a small illustration here. So this is a question, let's assume. Let's focus on question. So opening inventory, you have $70,000. You have purchases of $210,000. You have purchase discount of $5,000. You have freight in. What is freight in?
Cost of
Cost.
raw
It will
material.
add it into the cost, sir.
Yeah, cost of bringing the inventory into current location available for sale. Right? So that is how much? $10,000. So, and then you have a sales of $200,000 and you have sales return of 4,000 and GP ratio is given to you is 30%. Now you need to calculate the closing inventory. How do you calculate the closing inventory? Opening inventory plus purchases minus purchase discount plus freight in.
Freight in.
How
Plus
much is
total sales.
sorry? How much is total goods available for sale?
Sir, 1 second.
Just do the math.
285.
285, right?
Right.
So 285 is the inventory available for sale. And your sales is how much? 200,000.
Yes, sir.
And how much would be the cost of goods sold? 30% is GP, so 70% is cost of goods sold. So 70% of 200,000 is 140,000.
Yes,
right?
sir. Yes, sir.
So 140,000 if you reduce from 285, so how much will be a closing inventory?
145.
145,000. So let's see here how the solution. Opening inventory 70, purchases minus discount plus freight, goods available for sale 285. We have sales minus sales return. Sorry, we missed 4,000 sales return.
Yes, sir.
So your net sale is
मैं वहीं से
196.
confused हो गया कि sales return आपने total sales में
Yeah, sorry, my bad. And then less GP 30% margin 58,800. So your sales cost, that is cost of goods sold, is 137,200. So ending inventory is 285
minus 137.
$285 minus $137,500.
500.
Right? So your ending inventory is this. Right? Everyone agree?
Yes, sir.
Yes, sir.
Okay. So let's have one quick question here. Cracker INC had an explosion in its plant and that destroyed most of its inventory. Its records show that beginning inventory was 40,000 and they have made a purchase of 480,000 and sale of 620,000 during the year. Its normal gross profit percentage is 25%. It can sell some of its damaged inventory for $5,000. The insurance company will reimburse Cracker for 70% of its loss. What amount should Cracker report as a loss from exclusion? So let's do one by one. How much is the opening inventory?
Sir, opening हो गया
40,000.
$40,000, right?
Yes.
How much is the
Purchase
purchase?
is 480.
480. What is the total? 520.
520
520 is available for sale.
sales.
And then you have sold 620. If you multiply by 75%, how much is the cost of goods sold? 75% of 60?
165,000.
75% of
75% of 620 is how much?
465,000.
This is sales का
465,000
Yes.
minus 540,000. 541234 minus 465,000. So you have 541234 minus 465 is your cost of goods sold. So you have 75,000 closing inventory. Yes.
I'll be lost you.
Sir, एक second.
Let's do the math here. So 1 second. Let's see here. Opening is how much?
40K,
40,000.
40,000,
Right. And then purchase
480.
481234. So inventory available for sale is
520.
okay. Available for sale is 520, right? And then you have sales how much?
6,20,000.
620.
621234, right? And your COGS at the rate of 75%.
4 lakh
Plus
60.
this multiplied by 0.75, right? 465.
Yes,
So
sir.
out of this 520, you have already sold 465,
Right.
right? So you have 55,000 inventory. Estimated inventory is 55,000, right?
Yes, sir.
In this, you are expected to receive 70% from the insurance company, right?
Yes, sir.
No.
38,500 होगा.
Right, sir.
38,500 and salvage is 5,000, right? So your actual loss is this minus this minus this.
11,500.
Oh, sorry. I think
20%.
here,
70.
I think this will insurance may be coming later. I think so. 1 second. So out of this 5,000 is the salvage. So your loss is this minus this, and this into 0.7 is your insurance, and your actual loss is this minus. So your 55,000 is closing inventory.
Yes, sir.
इतना damage हो गया.
Right? And salvage value is 5,000. So loss, gross loss is 50,000.
Right.
Right.
Insurance you received 35,000. And net loss is how much?
15,000.
15,000. So that's how this 15,000 is being derived. Make sense?
Yes, sir.
Any doubt?
No, sir.
No, sir. Clear.
Okay, so we are almost in the end. So lower of cost or market. This concept is only in US GAAP. This concept is nowhere in IFRS or nor in Ind AS. Because of the LIFO method of inventory or retail price inventory method, which is being available in the US GAAP. Why this lower of cost or market? What is market? Market is basically a replacement cost of unit. So market price is called replacement cost of the unit of inventory. Is called, what is NRV? Do you guys remember? Net realizable value.
Yes, sir. कितने पे बिक सकता है वो market में?
So that is your sales price minus cost to complete the sales. That is your NRV, right? Everyone agree?
So,
right? What is net realizable value? The amount at which you will be actually realizing of the current inventory
from sale.
So your sales price minus any additional cost you are expecting to make the sale. So that is your net realizable value of your inventory, right? So now let's understand market. This is a new concept for you and you guys are not exposed to it. Just be careful and pay attention to it. So market price is the replacement cost of a unit, but it is being considered floor as well as ceiling and the middle effect. So let's understand what is ceiling. Ceiling is the highest price beyond which it cannot go to the market price. And floor is the lowest price below which the price cannot go. That is called floor. So now let's understand what is ceiling. Ceiling is the replacement cost exceeding the net realizable value, in which net realizable value will be the market price, and this is being calculated to prevent overstatement of inventory. Or what is floor? Floor is the replacement cost is less than the NRV reduced by the normal profit margins, in which market will be the floor. Practically, we will not be selling the inventory below this price, because if we are considering that in future the sales will be below this price, that means we are understating our inventory. How it actually works? The top, the floor, is the net realizable value minus the normal profit is your base. I'll do by an example. We'll do an example also on this. Just first understand the concept. So net realizable value is the ceiling. Net realizable value minus the normal profit is the floor. Right? So you got the you got the ceiling and you got the floor. Right? And if the replacement price, what is replacement price? To purchasing the same unit or replacing the same unit with the new unit, how much cost you need to incur, right? If that price is in between this top and bottom, then that price is considered as a market price. If the replacement price is more than net realizable value, then net realizable value would be considered as a market price. And if the replacement cost is less than the floor, then floor is considered as the market price. So for example, let's assume you have NRV of, let's say, $150 and you have margins, or you can say normal profit margin of $50. So your floor price is how much? 150 minus 50, right? So you have ceiling, NRV oblique, you can say ceiling, and NRV minus normal profit is your floor. Make sense? So this is independent calculation you need to do. And then you have a replacement price. That means purchasing the same unit from outside world, right? And let's assume the replacement price you have can I delete this? Hope this is fine.
Yes, sir.
So
Yes,
let's
sir.
assume you have replacement. You have, let's assume, $170, and then you have, let's assume, $120. Then let's assume you have $80. So these are the three replacement prices you have. So in this case of scenario, what will be the market price? You need to calculate the market price. So what it's saying, if your replacement price is 170, which is above the ceiling, so you need to consider ceiling as the market price. So then this ceiling is your market price. If you have replacement price in between the ceiling and the floor, in between the ceiling and floor, then this 120 would be considered as your market price. But if you have replacement price below the floor, then floor will be your market price. Make sense? Now this is a new concept and you'll definitely getting the question because this is specific to US GAAP. So you'll definitely see a question in your exam for this. Any doubt here? How to calculate, floor, how to calculate ceiling, and how to calculate?
सर एक बार फिर से एक बार बताना, ये मेरा थोड़ा कंफ्यूजन.
First, you need to do this independent calculation, right?
सर ये given होगा already question में.
Yes, you will be given the information. Without information, how do you calculate? Yeah, yes.
Okay.
So all the information will be given to you, but you need to do the application, like how to apply those information to calculate the market price, right? So first you need to do independent calculation of the ceiling and the floor. Ceiling is your net realizable value. What is net realizable value? Your sales price minus cost to complete the sale, right? That we all agree?
Yes, sir.
Right? So you have done independent calculation of ceiling, which is $150. Then the profit margin is also being given to you. Let's assume $50 is a profit margin, or let's say 1/3 is your profit margin. So $50 is your normal profit margin, which you generally charge in the market, right? So if you're reducing the profit margin from NRV, it will give you the floor price. So this independent calculation you need to do first, where you identify what is the maximum price and what is the minimum price, right? Then you need to see how much is the replacement cost given in the question. If the replacement cost is given more than the ceiling, then you should consider ceiling as the market price. If the replacement price is below the floor, then you should consider floor as the market price. If the replacement price is in between the floor and the ceiling, then that replacement price is your market price. That's what we discuss here. If in question they have given you the replacement price $170, so what should be your market price? The ceiling, which is $150. Right? Make sense, Kashish?
Yes, sir.
And if they have given you $120, that is in between ceiling and floor. So then you consider replacement cost as the market price. If they have given you $80, which is below the floor, then you need to consider floor as the market price.
Got it, sir. Got it. Clear.
Right? So here, if you see, the NRV is equal to ceiling, which is replacement cost above the ceiling. And if replacement cost is in between ceiling and floor, then that is the market price. And floor is replacement cost below the floor. So market price is equal to floor price. And floor price is NRV minus normal profit. So market price determination. If the replacement cost is between NRV or NRV minus normal profit, then market price is replacement cost, which we have discussed just. If the replacement cost is above NRV, then market price is NRV. If the replacement cost is below NRV minus net profit, then market price is NRV minus net profit. So just look at this illustration. So here they are saying sales price of product X is $500. Estimated cost to complete the sale is $100, right? So what is NRV? $400. And your normal profit is 10%. 10% is $50. No, 10% of sales.
Okay.
Right? $50 is your normal profit. So your NRV, which is ceiling, is $400. And your floor is how much? $350. Right? NRV minus normal profit. Got it?
Yes, sir.
Yes, sir.
And they have given you the replacement cost of the product is $375. So your ceiling is $400, floor is 350 and replacement price is in between, which is 375. So hence your market price is also 375. Make sense?
Yes, sir.
Right?
Yes, sir.
And you need to do an adjustment entry for loss due to decline in inventory value to allowance for reduce in inventory by 125. Lower of cost or NRV, we all know, right? Let's do one last question. When a company applies the lower of cost or market method, report its inventory as accounted for under the LIFO method at replacement cost, then which of the following statement is true? The original cost is then replacement cost. The net realizable value is greater than replacement cost. Have you understood the question? Have you understood the question? What is the call of the question?
क्वेश्चन तो समझ आ गया, वो दो स्टेटमेंट में नहीं समझ आई मुझे।
Once again, first let's go through question again. When a company applying lower of cost or market method report its inventory under the LIFO method at replacement cost. That means when you are reporting your inventory at replacement cost using LIFO method of inventory, then which of the following statement is true? That means you are using LIFO method and you are using lower of cost or market method, right? So in lower of cost or market method, is there any statement called the original cost is less than the replacement cost? Have you seen any such statement?
No, sir.
Right?
No, sir.
Second thing, the net realizable value is greater than replacement cost. So that statement you have seen?
Yes, that is possible.
Right? That is possible, which we have discussed here, which is called the ceiling.
Oh, yes.
Right? Hence
Sir,
this.
then we will consider the net वो NRV cost को consider करेंगे ना वो तो?
Yeah. So hence the B statement is correct in this situation.
Okay.
So second वाले point में the net realizable is greater than replacement, then we will consider the net realizable value ना?
Yes.
That case.
Yes. No, sorry. Net realizable value is greater than replacement cost if replacement cost is in between NRV or NRV minus normal profit, then replacement cost would be considered as market price.
Okay, sir.
Look at here, if like replacement cost is 120, then 120 is considered. If replacement cost is 80, then 100 will be considered.
बहुत है सर।
Hmm?
एंट्री का चैप्टर ऐसा हो गया भाई, मुझे तो नींद आनी शुरू हो गई सर।
No worries, I think we are done. So I'll send you this updated notes. So you can go through and do some practice question also.
Yes.
Right? So we are done with the inventory.